Please guys, if you don't know how to trade, you didn't trade before and you don't understand it, then don't do it. You will simply lose your money. So what can you do? Well, you can borrow money from your friends and then you can trade. So about the green and the red candles that you have seen here, as I said, this candle presents prices, the fluctuations of the prices in some time frame. Let's go back into, let's say, 10-minute time frame. So each of the candles, so this is a 15-minute time frame. You can see here each of these candles, this green or red candle, they represent a time frame of 15 minutes. And you can see that there is a body of the candle and there are some little wicks at the end of these candles representing something. So when I go back here, now I can maybe clean this up just to show you how to read those candles, so you know. So when you are showing the price, so you have a green candle and a red candle. As I said, the green candle represents the increase in price. Okay. Let's say here, maybe like here. And then there is a more selling pressure, and then you have a price going down. Like maybe this. Okay, then it can go up again. Okay, so how to read these graphs? So there is also, it can be like this. How to read these graphs? So each of these candle has 4 different prices represented in one candle. One particular price is this, and this. These are the 4 prices. This is called the body of the candle, and these are the wicks. So if this candle represents 15 minutes, it says this. During these 15 minutes, the opening price on the markets for the green candle was this. So this is the opening position, so opening price. This price was the closing price. So at the beginning of this 15-minute interval, the price was here. At the end of this 15-minute interval, the price was here. But during this 15-minute period, the price went up to this ceiling price, to this maximum price in these 15 minutes. So this is the top wick price and this is the bottom wick price. So it went all the way up to here in these 15 minutes. It went back, it went all the way down to here, and then it went to this closing price where it closes. So in this chart, it's compressed information. So if I expand this one candle in a graph of 15 minutes, so you have an opening price, this is the opening price, you have the closing price, this is the closing price, you have the minimum, and you have the maximum price. So the opening price is here, obviously. The closing price is here, obviously. You here have the maximum and you have here the minimum. So the prices go something like this. Like this. So all of this information, the price went up and down this 15 minutes, all of this information is compressed here in one single graph, showing only the opening price, the closing price, and the max and the minimum price in this interval. And that's why you have different time resolutions when you're checking out the graphs. For the red ones, obviously it's the other way around. You have the opening price here. So here is the opening price, here is the opening price, here is the closing price. Because the closing price is below the opening price, that indicates that the price went down. You have the minimum and maximum price, those wicks, basically the same thing as here. So the maximum price for this asset in this 15 minutes candle graph, and the minimum price. And that's how you should read it. Why you don't go into this kind of graph, you go with this kind of representation? Because it depends on the asset. If you're looking, let's say we can go now back to the charts. If you're looking at the S&P 500, so these movements of the prices, so this is the 15 minutes, you have different kinds of, let's say, you can now, here you have a tool, and we can see here it's 0.93% change in price from the 13th of December, and here is, I believe, it's the 11th of December. So in 2 days, basically the fluctuation of the price is 0.93%. So that's why it's a very slow asset class, so it changes very slow. That's why maybe you don't need this kind of information, all of the information about the prices in each second particular. But if you go, let's say with Bitcoin, then you will see here in the past 2 days, let's say from here to here, it's 2.5, it's 2.5%, 2.6%. So you can see that the 15-minute chart, it plays a different role, and you get a different kind of information based on the assets that you are buying. If you're buying S&P 500, the changes are very sluggish, slow, then you don't need to check the price every second. But if you are going with Bitcoin, where there is a lot of volatility in the market, so there are a lot of people who are trading up and down, a lot of changes in demand and supply, then you have to monitor it on the lower time scale, and because there are big fluctuations of 2 or 3%, or it can be 10 to 20% per day. That's why you need different kinds of time frames. Know now what those green and red candles mean when you're looking at the graphs. Okay, but what's trading? What is trading? Trading is basically the operation when you are trying to predict how the prices will go in the future. So this is the information that you have for now, but you want to know where the prices will go in the future, and that's what's trading. Because if you believe in this asset, because let's say it's a Bitcoin, if you believe in this asset class and you know that it will go here or it will go to 300,000, maybe the price of $100,000 is a bargain price for now. Earlier in 2011, $100 for a Bitcoin was a bargain price, but today it's another story. That's why, if you believe in this asset class, if you understand the background of this asset class, that's why you have to read, you have to monitor. Then maybe you will buy it on this level because you believe that it will go up. That's what's trading all about. And also, if you are predicting that the price will go down, then maybe you can, let's say, buy it out in the future. It's called shorting. So that's why you have longing and shorting. Longing is when you, let's say, predict or when you bet that the price will go up, and shorting is when you bet that the price will go down. It's basically you earn money if you long the asset that will increase in price, and you also earn money if you are saying that the price will go down and the price actually goes down. So why the price, someone will say, why the price is going up or down sometimes? There are a lot of factors why the price can go up and down. Because of the situation in the markets, obviously, because of the supply and demand, because there are a lot of people that are willing to buy something or sell something at a certain price. There are also micro and macroeconomical situations, because maybe there's some kind of a war or some kind of black swan event, something happened, an earthquake or something like that, and that's why, because I don't know, the war started, that's why the price of gold has increased. So if you are looking at the charts of the gold, then you will see that all of the years when there was a war breakout or something like that, the price of gold increased, because people are like that. When something is, say, bad going on, they somehow believe most in gold, and they believe that their fiat currency or whatever type of money they are having, that it will diminish in their value, and that's why it's better to have something preserved in gold, because it showed over the years that's a good way to fight the inflation, fight the war environments and so on, and all different kinds of political unstable situations that you have around you. People now will say, okay, but if you're betting that the price will go up or you're betting the price will go down, it's betting. So basically there's no difference of going to casino or something like that. It's not. It is if you don't understand the asset that you're looking. So you can look at Bitcoin, you can look at gold, you can look at oil, you can look at gas, and so on. But if you're buying or selling or betting that it will go up and down in price just because you think that, then it's a gamble. Okay? Then you're making a bet. But if you are looking at the supply, at the demand, you understand, let's say for the Bitcoin, you understand the technology that is behind it. You understand how many institutions are already putting inside, how many government institutions are now planning to go with some kind of a reserves in Bitcoins. You understand how much Bitcoin there is, how much there will be, and so on. Then that is not a lucky guess. Then there is always risk. Every asset class can go down, everything can go and perish. But if you understand what you're doing, then you are lowering your risk. And then it's not a bet. It's not a bet if you are gaining money 80% of the time and you're losing money 20% of the time. Then it's not a bet. That's an asymmetrical situation. You understand? And you want to have this asymmetrical situation. So you have to keep track of two things. In the markets, they are called analysis. So when you are doing different kinds of analysis, there's something that's called technical analysis, and there is TA, so TA, technical analysis, and fundamental analysis. So if let's look at Bitcoin, because I'm tracking Bitcoin, I know a lot about it. So, but it applies all the same thing that I'm talking now. It applies on every other different asset class. So you have a Bitcoin price, let's say like this. When you're looking, what is the technical analysis? Technical analysis is when you are trying to figure out where the price will go, only checking the graph, only checking the history of the price going up and down. That's So you can see here the price go up, down, maybe because it went up and down here, maybe here will go something like that. That's pretty much technical analysis, and it uses different kinds of, let's say, trading patterns. So if you're looking at this graph, or I'll make another one, you can see in most of the cases, prices can go like this, okay, like this. And then what it means, you can see here, if you're looking at this graph, you don't see anything special. But if I make some changes here and put like this, some lines like this, or put lines like this, and put lines like this, and put lines like this, then you can see how this price is bouncing off these blue lines, these blue invisible lines, and basically those lines are representing the trend of the price. They are representing how the price is supported by this blue line and how it is rejected from this another line. And then when it breaks out, so here is the moment when this price breaks out from this funnel, then it's the time, in most of the cases, when traders get into their trades and say, okay, the price broke down this support line, and then it is higher probability, nothing is certain, but it's higher probability that the price will go down, and then that means that I will short this asset. Also, if you have this kind of situation here, let's say you have this kind of, and this, let's say this is a double bottom pattern, it doesn't matter, but let's say here, then you have a price that's going in this funnel like this, and then it breaks out to the upside, meaning there is a higher probability that the price will continue to go up, and then that is longing, so they buy. And that's why in most of the cases, 80% they will gain money, because this is only technical. You don't take into consideration what is going on in the world. Maybe someone broke the Bitcoin code, and regardless, all of the technical analysis, all the patterns, trading patterns that you are seeing here, and there are thousands and thousands of different kinds of books, and you can download regarding these trading patterns. But it doesn't make any kind of sense if you are a real trader if you don't do also the fundamental analysis, and that's what you need to know more about the macroeconomic, the political situation, what is going on, because if this breaks out here, okay, so the patterns say in most of the cases, if the price breaks out this resistance line, the price will go up in 95% of the time. But as I said, maybe someone broke the Bitcoin code, and all of this technology went flushing down the drain, flushing down the toilet, and what will happen? The price will actually go here to zero.
What? Bro, what are you talking about, man?
And that's why you need to pay attention on both type of analysis. So trading is hard, it's not for everybody. The normal people who are not traders, they are making, most of the cases, they are making the initial mistakes that are rookie mistakes. And that's why when there is a lot of hype, let's say Bitcoin today is $100,000, there is a lot of hype, and they are afraid of missing out. It's called FOMO, fear of missing out. So they are going into it now when it's 100,000. Why didn't they buy it when it was 15,000? They are going inside, and other people, the big traders, the big boys, they understand when these small taxi drivers or your barbers are going and buying Bitcoin, that's the time where you should sell. So when your barber or your taxi driver say that you should buy Bitcoin, it's a good time for you to sell your Bitcoin, because all of the people, they are buying Bitcoin here. So there is no sense, no logic to buy it here. You should have bought it here while it was, I don't know, 30,000, and sell it here while it was 100,000. But now it's hype, it's all around the news, and they want to get on the train, and they buy it at 95K. The price is already so inflated, there is no more demand for Bitcoins, at least for next, let's say, 5 months or 1 year. Then the price, and in most of the cases you will see that when you buy something, in 1 week the price will go like this, and it will go to, I don't know, 60,000. And then you will say, oh, Bitcoin is all rubbish, it's all shit, it's not worth, and I don't care, I was so ripped off in Bitcoins, it's all a scam, blah, blah, blah. It's not a scam. You don't simply know how to trade. You're an idiot. That's all what it's all about. You are buying things when they are the most expensive. And then when it comes to 60K, you are in panic because you now see that you have lost money on this trade, and then you are in panic, you are trying to sell your Bitcoin at 60K, lowering the prices even more down because you are afraid that the Bitcoin will go bust and you will end up with zero. You will not have anything from it. And in most of the cases, that's not, at least for the Bitcoin, it's not the case. Bitcoin has its cycles. It goes up, the demand vanishes, and then it starts to go down. And then after some time, it returns back, and it all in most of the cases it breaks the previous all-time highs. But you have to wait, and you have to understand and wait. Maybe this 60K in 5 years will be 6 million, but you have to wait, and you have to know what you're doing. That's why most of the people are losing money, because they buy when it's hype, and they sell in fear that they will lose their money, and basically they invest 100, they get out with 60, and there is a 40K minus, and they say that trading, it's a scam, it's a shit, it's all rigged. So as everything else on this world, the rational thing is to buy things that you believe in, that you believe that they have a great price, that people will want. It's scarce, the people will want in the future, to buy it when they are on sale, on discount, where the price is low, and wait till the price go up. So that's all that is to trading, to buy low and to sell high. That is it. Also, people are, when they are trading, especially these people, when they are trying to buy during this hype, what happens is they go to the bank and take a loan because they want to buy as much as, let's say, Bitcoin as possible now, because the price will go up and up and up. And that's biggest mistake you can get. To trade and to go into trade with your and with additional borrowed money, it's called leverage. So leverage is when you trade with someone else's money, and then if the prices go down, what you get is you get a capitulation. What it means? It means that let's say this is a pie, so this is your money, this is your money, my money, and this is the borrow money. What happens is when the price goes down, if I go into minus that covers this part of my investment, I've left with zero, so I invested $100 and I don't have anything off of it. But if I borrow times 10, So it means that I have borrowed, I have $1,000 I have borrowed, so the cumulative effect is $1,100. If the price goes down, I start to lose money, minus 40, minus 60, minus 80, minus 100. And after that, I am kicked out of the trade because my money has gone. There is no more. And the borrow money you have to return. Luckily, most of the, let's say, the crypto exchanges and trading platforms have this automatic possibility. If you lost your own money, the platform will not let you lose their money, because the platforms, in most of the cases, the platform themselves are giving you the possibility to borrow the money from them. And then if you lose your money, the platform will not give you the possibility to lose their money also. So you will be kicked out of your trade automatically. And basically, that is it. But if you borrow money from the bank and you lose your money and bank's money, guess what? You will have to pay back the borrowed money from your bank.
No!
Including interest. That's why it's very, very risky to use leverage in any occasions, especially if you're not a trader, you don't know what you're doing, and you go in this kind of degenerate trading, this hype trading, using a high leverage. So you go, some platforms give you the opportunity to go times 100 of your initial investment. If you put $10, it will give you $1,000. So you go into a trade with $1,010. But you can understand, if you go with that kind of money, if the price will switch and start to go down, if you are betting that it will go up, but it start to go down, when you lose your first $10, you will be kicked from the platform because you have lost your initial deposit, you have lost your $10. Okay, so I believe I have said a lot of things about trading and so on, but I will want to show you how the trading is done on a proper, let's say, crypto platform. So the next time I will open an account on, let's say, on Bybit or a similar platform, just to show you the different types of trading, how you can, what is a market order, what is a limit order, what is a stop loss, what is a trail stop loss, what is a take profit order, what is a spread, what is an order book, maybe some trends, maybe some to show you this kind of analytics. So the technical analysis, the support and resistance lines, and so on, the Fibonacci tools or something like that, the moving average, what's the difference between spot and futures trading, the fees that you have to cover and have to pay, and what's hedging, what's some good practice when you want to trade. Let's say you should never put into one trade more than 1 or 2% of your deposit. It's simply lunatic or degenerate if you're putting all of your money into one single trade, because you can get kicked out very easily, especially if you're using leverage, and so on. But I will show you directly on my computer screen, on the platform itself, how this is done, what is these different kinds of orders, and how you can make your own trades in the future. So guys, have you learned anything about markets and trading? If you have, please share some of your comments, or maybe you are already a trader and you want to correct me if I said something wrong. Put it in the comments. Share, like, and subscribe, and I will see you soon. Bye guys. And guys, if you want to learn more about certain topics that we are covering in this podcast, like how to do affiliate marketing, how to do trading, crypto, forex, finance, general finance, and you want to learn more about how to escape the ordinary, how to escape this matrix pit and know the information that I am personally learning, then you have a possibility to enroll and to find out more in this game changer application. So the application is also available through the link that is available on my personal page. So you have a link here in the descriptions that you can go and check by yourself.